Hi everyone, Alex from Summerhill with a quick update on this week's federal budget. Now, similar to last year, there weren't too many surprises from a wealth management perspective. The announcements were relatively modest, but I still wanted to highlight a few of the key areas that may be relevant to you. So, starting off with the potential impact of the budget announcements on Australian assets. Now, while forecasts are always fraught with danger, it is viewed that overall it's a relatively neutral outcome for shares, property, and the Australian dollar. Medium term deficits could put some upward pressure on bond yields, and from a cash and term deposits perspective, while it's expected the Reserve Bank will start cutting rates this year, the budget may keep rates a little higher than otherwise expected. On a personal tax front, the government is making gradual reductions to the lowest marginal tax rate. So from 1 July 2026, the tax rate for income between $18,201 and $45,000 will reduce from 16% to 15%. From 1 July 2027, it will reduce further to 14%. So what does this mean in dollar terms? In the 2026-27 financial year, we could see a maximum tax saving of $268. And from 1 July 2027 onwards, the savings could increase to a maximum of $536 per year compared to the current rates. While this isn't a game changer, it does mean a little extra cash flow in your pocket, which could help you with your broader financial goals. Impact on financial planning strategies. I guess it's worth noting that the effective tax-free threshold, so that is the amount of money you can earn before paying any tax, will increase slightly for most from $22,500 to today to $23,200 from 1 July 2027. This could be relevant if you distribute funds from a family trust to lower tax family members, or if you're gradually paying out dividends from a company to manage tax. Interestingly, from 1 July 2027, the marginal tax rate for income between $18,201 and $45,000 will be lower than the 15% superannuation contribution tax rate. So for those in this income bracket, making voluntary pre-tax contributions to super may no longer be tax effective, but frankly we already see limited benefit for individuals on the 16% tax rate when making pre-tax super contributions, and this change will only become even less compelling. We'll discuss these changes and how they impact your strategy in your next planning meeting. So moving on to help and student loans. While this may not impact most of you directly, it could be relevant to clients with children. As previously announced in November 2024 by the government, from 1 June 2025, all outstanding help and student debts will be reduced by 20% across the board. The minimum income threshold for making repayments will increase to $67,000. And the repayment rate will also shift to a marginal system rather than being calculated on a total income. So these changes will reduce repayments for those earning around under $180,000. If you have children with student loans, it could make sense for them to avoid making additional repayments until after the 20% reduction. Additionally, these changes may also impact those of you distributing income from a family trust to your kids, and how much you ultimately distribute. So moving on to business taxation. On the business side, there were no new measures announced. However, as a previously introduced measure is coming to an end, the 20,000 instant asset write-off will finish on 30 June 2025. This allows small businesses to immediately deduct the full cost of eligible assets under 20,000. If you run a small business and are considering asset purchases of less than 20,000, it may be worth bringing forward those purchases to before 30 June to take advantage of this tax relief if eligible. Moving on, there were no major changes to Social Security or aged care. For Social Security, it's worth keeping an eye on the deeming rate freeze, which is scheduled to end on 30 June 2025. Deeming rates impact those receiving government benefits like an age pension or holding a Commonwealth Seniors Health Card. If the freeze isn't extended, many recipients could see a reduction to their repayments or lose eligibility. On the aged care front, while there were no new budget announcements, it is important to note that significant reforms already legislated will come into effect from 1 July 2025. These include changes to accommodation costs and revisions to means-tested fees. These changes will increase the cost of care for most, and while we recognise this doesn't impact many of you directly, we have an increasing number of clients assisting other family members with aged care, and if you are helping your parents with aged care decisions, don't hesitate to reach out to us to discuss how these changes might impact them. So moving on to superannuation, there were no new changes to superannuation in this budget. However, it is important to remain aware of previously announced but yet to be implemented measures, arguably still on the table as part of the government's superannuation policy. So specifically, the Division 296 tax, which would essentially apply an additional 15% tax on earnings for those with balances of above $3 million in your superannuation. This remains on the table. This tax would cover both realised and unrealised gains and apply to balances in both your total superannuation, so includes balances in accumulation and retirement phase. Considering there was no mention of any changes to this proposal, the government is effectively committed to taking this tax to the next election and haven't moved away from their methodology in calculating the tax, despite the proposed method effectively taxing unrealised capital gains, which is a highly controversial topic. And additionally, it's viewed as quite a complex tax initiative that would be very difficult and costly for the ATO and superannuation industry to implement. So legislation to implement this change is currently before the Senate, but has failed to pass at this point in time. For those of you with larger super balances, it's worth noting that if legislated, while the tax would apply from 1 July 2025, you would have until 30 June 2026 to restructure your fares if deemed appropriate. As we've previously discussed, we don't recommend making strategic changes to your strategy based on proposed legislation. The changes would require successful return of Labor to government and support in the Senate to pass. We'll be watching this closely and we'll update those of you whom it impacts if there are any updates. So that's it from us for today. As always, it's important to remember that most of the budget announcements are just proposals at this stage and still need to be passed into law. We'll discuss how the changes impact you in your next planning meeting. But if you do have any questions in the meantime, feel free to reach out. Thanks for watching and take care.